I'm here with Mike Rarey from CAP STRAT. Hi, Mike. How you doing?
I'm good, Will. How are you?
Doing great. Today, we thought we would do a little different format and just have a conversation about some macro things, macro themes, macro ideas that we've been sort of debating internally and wanted to just share some of the research we've been doing with our listeners and really take a step back and have it be more of a primer on what's going on in the global economy, specifically within the US, and how we're issuing a lot of debt right now during the pandemic and as we move through this crisis. So we wanted to just talk through what that means and what the implications might be and help the viewers understand a little bit better as to what the expectations for long-term outcomes are with respect to all this debt. So Mike and I have put together a slide deck here. We're just going to walk through it. Unlike other past programs we've run, we're just going to go back and forth and talk about the slides here. So we're first going to start off with what's going on in the growth area with the money supply and the velocity of money. And we've got a chart up here, and I'll let Mike walk through it. But really, this is sort of the basis or the foundation for the series of things we'll talk about over the course of the next few weeks. So, Mike, take us through the more money, slower growth slide.
All right. So, taking a look at this slide, what you'll see basically before the 2008 global financial crisis is traditional monetarist views of how money is created and how it leads to growth. All those traditional relationships hold true. And then something happens in 2008. So, the blue line, which represents the monetary base, which is basically the amount of reserves in the banking system that are created by the Fed, you see it surges. It goes off and to the right. And traditionally, if the Fed was creating money at that type of a clip, what you would have was very strong growth and potentially hyperinflation and devaluation of a currency. That's what, if you go back to 2008, that's what people were calling for. When all those emergency tools were being launched and the Fed launched quantitative easing for the first time. But what you'll actually see happen was the velocity of money, which we can explain what that means, but it's a good metric of how money creation actually leads to growth. It's been falling and it's at an all-time low. Mm-hmm. So that relationship totally switched in 2008, and it sort of threw a lot of monetarists off the scent, if you will, sort of looking for an explanation as to how this could happen.
Right. So maybe we'll start with monetary base. Like, explain what the monetary base is, and perhaps like how it flows through the economy and what a bank reserve is.
Yeah, it's important to understand the tiers of money and how they're created. When you traditionally think of money, you just think of coins and dollar bills and notes. But really, there are a lot of different definitions of money and how money is created. So you start first with the monetary base. That's sort of the highest level of money, the base of the entire monetary system per its name. And what it essentially consists of are bank reserves. And bank reserves, if you look at the Federal Reserve's balance sheet, bank reserves are a liability of the Fed, and they are an asset of banks in the economy. So understanding the monetary base is the first thing. That when the monetary base is increasing, the Fed is increasing the potential amount of money that can be put into the actual economy. They're doing it by going to bank balance sheets and saying, okay, you have a treasury bill, you give me the treasury bill or the treasury note, I'll give you bank reserves. Mm-hmm. And they're increasing the monetary base. The amount of the increase in the monetary base that actually gets into the economy, that's where you go from monetary base to M2, or the money supply. There's a lag there. So that's the second level of money. And M2, or actual money in the economy, can only be created by banks.
So explain that. So they have to do that through lending.
Yes, that's right. So you think that the Fed increases the monetary base, and you think, well, all that money is just going to go into the economy. Well, no, it depends on a couple things. All the Fed is doing is putting bank reserves on bank balance sheets. Mm-hmm. In order for the money to then get into the economy, the bank has to lend it out. And then the person who received the loan has to spend it.
Right. I think first somebody has to want the money, right?
Yeah.
which is one part, but the bank has to actually lend it. I think there's a misperception of just because the Fed gives the bank money that they're lending it out. The reality is that is not happening, and it happens in a dysfunctional way at times, specifically times like now. So maybe explain sort of how that process works.
Yeah. So when a bank has a treasury note and the Fed comes to them and says, "Here are bank reserves, you give me the treasury note," the assumption is the bank will then take that bank reserve and create a loan. But if the bank doesn't have an incentive to make a loan, meaning there are no creditworthy borrowers, or there's very little profit incentive to make a loan, so their net interest margins are very low, or for other regulatory reasons, they would rather just keep the bank reserves so they look safer from a capital and liquidity perspective. Mm-hmm. What happens is a lot of these bank reserves never get lent out. They just stay on bank balance sheets. So if we had on this slide excess bank reserves, you would see it's going up and to the right, just like the monetary base. So less and less of the money the Fed is trying to create is actually getting out into the economy. More and more, it's just being hoarded by banks for various reasons.
And another disincentive for the banks to lend it is they're getting paid on those bank reserves.
That's exactly right. In 2008, and this is a big part of this, the Fed created a new monetary policy tool to help them manage the federal funds rate, and that's the interest rate on excess reserves. Mm-hmm. So for the first time ever, if the bank starts out with a treasury bond on their balance sheet, the Fed says, "Give me the treasury bond, I'll give you bank reserves." Now, if that bank does nothing with those reserves, they just keep them, then they get paid by the Fed to keep them.
Right, and so that was the bank's like any other business. They are in it for a profit and in it to not take too much risk. So that is a low risk way to make money.
That's correct. Yeah.
Okay. So you want to continue on with once the bank has reserves, and how they think about lending.
So step one, an increase in the monetary base is not resulting in a sort of one-for-one increase in the money supply, because a lot of these bank reserves are just being hoarded by banks and not being lent out. And then the second step of this is the dollars that are being lent out are not being used for GDP producing transactions.
Yeah.
So, and that's where you get to the velocity of money. So basically what the velocity of money says, say that I get a $10 loan from a bank, and I take that money and I go buy a good or a service. I go buy a sandwich. Well, then the velocity of those dollars is 1. Each of those $10 was used to create $10 of GDP. Mm-hmm. Now, if the sandwich shop I bought that sandwich from takes that money and deposits in a bank, well, then the velocity of those dollars was 1. Those $10 only created $10 of GDP, so 1. Now, if that sandwich shop takes it and goes out and buys a sandwich themselves, now that same $10 actually represents $20 of GDP. So the velocity of that money is now 2. Mm-hmm. So that's very important as well. So what you're seeing with this green line falling is increasingly, even if you're lucky enough to get a loan from a bank, you're not using it for GDP transactions. And if you are, it's only being used 1.3 times. So it's only been cycled through 1.3 times. Mm-hmm. We know it's going somewhere, but it's not being used to buy goods and services. So that's where you get this idea of the Fed sort of pushing on a string, if you will. They're trying to create money, but that money is getting hoarded on bank balance sheets. And then the money that's getting lent out, it's not being used to buy things as much as it used to.
Right. So that's a great example of the way velocity works. But explain what happens when you get the $10 and you don't buy a sandwich. You do something else with it that's not productive or doesn't add to velocity.
Well, that's a great point. So traditional monetarist thinking would suggest that all dollars are only used for GDP producing transactions. But that's been disproven. So if you look at something like the quantitative theory of disaggregated credit from Richard Werner, he suggested that if I get $10 from a bank, I may spend that money, but not on something that gets counted towards GDP. If I take that money and go buy stock, buy equity of a company, that transaction never gets reported as GDP. So what you get is, you would traditionally think, oh, this money is being created. You're going to have inflation of goods and services.
Right.
Everybody's going to be buying sandwiches. They're going to go up. The price of a sandwich is going to go up, but that's not happening. What instead we know is happening, which is the basis of sort of our excess liquidity indicators, is money is being created, but it's not being used for GDP producing transactions. It's either being used to pay down debt for savings by the private sector, or it's being used to buy stocks, buy real estate, buy financial assets. If you're looking for where's the inflation from this, look at the stock market.
Right.
There's the inflation.
Prices, right. Yeah.
Yeah.
Yeah. It's a great point. I think that's a common misperception of people who think we should have rampant inflation. There has to be money going towards GDP transactions that creates that inflation. But in actuality, we have had inflation. I mean, house prices are insanely inflated relative to their base level prices. If you look at certain markets, they're incredibly overpriced. So inflation does exist in certain areas.
Exactly right.
Perhaps maybe we talk about maybe a little bit more about what are productive uses of debt, because when you take debt, it's a trade-off between future consumption for current consumption. So talk through sort of the productive uses versus the non-productive uses.
Yeah. The inflationary uses of debt and deflationary uses of debt is another way to put it. And that comes down to the income you're generating for every dollar of debt. So if I borrow $10 and I use it to invest in something that creates $12 of income, then I've created $2. And that use of debt is productive and it is inflationary. Mm-hmm. Now, if I borrow $10 and I use it to create incomes of $8, well, that is unproductive. And it's deflationary, because then what happens? Now I have a $2 shortfall. So when my debt payment, my principal payment comes due, now I need to borrow $12. So I need to take on more debt, which is a deflationary spiral. And it's going to be harder for me to get out of debt because I keep recycling this debt into things that give me less and less income. Excuse me.
Yeah, that's a really good point. And just for the viewers wondering who our crack annotator is, that's the amazing Audra. She runs all of these videos for us, and she does an outstanding job at getting us prepared and keeping us on point during these conversations. And now we've transitioned her to chief annotator for our deck. So we're glad to have her here.
Yeah.
So Audra, let's move to the next slide so we can talk about sort of the counterintuitive idea of we have lower interest rates, but we have more debt. It just seems a little counterintuitive why that relationship would exist, because you would think the more debt I have, then the higher interest rate I should be paying, because somebody wouldn't want to lend to me if I have a lot of debt. So walk us through this chart, Mike.
Yeah, what you see, the red line is U.S. debt to GDP, which you see it's at its all-time high. And then you have the interest rate on the 30-year Treasury note in the blue line, and that's at an all-time low. So these things, they don't really reconcile if you think about it. I guess you would say for basically any other person in the country besides the U.S. government, this relationship would never hold. If I take on more and more debt and I continue to use that for unproductive things, and my creditworthiness continues to deteriorate, and I go to a bank and look for more money, I'm not going to get a lower interest rate than I did the last time I asked them for money. It's going to be the opposite. So this is more a factor of showing that clearly the amount of debt that the government is accumulating is being used for unproductive uses in a deflationary way. And it's basically to the point where this is happening on a global scale. And every single time you roll over your debt and you have to borrow more than you did the last time because you used that money you got the last time for an unproductive use, you had a shortfall, you're destroying dollars. You're increasing your debt. You're taking more of your future consumption and bringing it forward. So future consumption just gets impaired more and more. Future growth expectations go lower and lower. And it's deflationary. So inflation expectations go lower and lower and lower. And those are the two things, growth expectations and inflation expectations, that drive bond yields, government bond yields. Because we know it's not creditworthiness, because the US government can print all the dollars it needs. It's never going to default. What you worry about is hyperinflation, and they're not generating inflation through this borrowing. Mm-hmm. So interest rates go lower and lower and lower.
Yeah. And is there a point where, at what point does that sort of break down? At what point do rate declines sort of fall off and deflationary spiral stop, and we move to an inflationary or hyperinflationary regime?
It's very difficult to say. There's been a lot of academic research on that topic. There's the one theory where it's sort of, more is not more, more is less, and you don't get out of this cycle. Mm-hmm. You have to pay down the debt, which nobody's signing up for that. I mean, that's a fiscal austerity program.
Going the opposite way, right? Yeah.
Yeah, exactly. So you have to pay down the debt. That's one way to try to get out of it. And the other is, eventually this could lead to hyperinflation if the government starts running such a large fiscal deficit, and it's being monetized by the central bank, which is not a situation we have currently, that everybody basically loses confidence in the value of a US dollar, and it depreciates so much, and then you would have interest rates rise and inflation expectations rise. So that's the other end game. They're both ugly.
Yeah, for sure. And I guess there's the whole idea or the concept of sort of the output gap. Like when you have such an extreme amount of capital and excess labor in the system, you have to close that output gap before you can actually stop the deflationary pressure.
Mm-hmm. Exactly right. You get increased demand. So say you create widgets and somebody gives you an order for 10 additional widgets, but you have capacity to create 30 additional widgets. Well, you don't need to raise the price on your widgets. Mm-hmm. You have no additional costs. You're just lucky somebody's filled that output gap. There's slack. Yeah. So increased demand is not met with increased inflation. But if you're operating at max capacity and now you need to open a whole new widget plant, or you need to recruit new people to make widgets, well, now you can see how your margins are going to get squeezed, and you need to raise the prices on widgets.
Right.
So that's the other thing. As long as we're just eating slack, then demand can increase all at once, and you're not going to get inflation.
Yeah. I don't know if we have a graph in here on that, but there's a tremendous amount of slack right now.
Yeah,
in the
definitely.
Economy. So let's move on to the next. Audrey, you want to flip us through to the next chart? Because this is really an important idea, and I want to sort of make sure we bring this down to the level of an individual so they can think about their own personal situation and relate it to that. But everything essentially in the economic universe is based on balance sheets. Like everybody has a balance sheet, and everybody's balance sheet generally is impacted by everyone else's balance sheet. So talk about what we mean by a balance sheet recession, and walk us through this simple graphic we have here.
This concept, balance sheet recession, is something that really wasn't even known to the economic community prior to the mid 1990s. And it was kind of discovered after Japan had their asset bubble burst in 1989, and then was pushing on a string for 30 years, trying to increase fiscal stimulus and lower interest rates to try to get the economy back on track, but it just wouldn't work. So the basic idea of a balance sheet recession, and contrasting that to your normal business cycle recession, is, you walk through this graph here. You start with, you have your assets equals liabilities plus equity, and you see your balance sheet is pretty small. But then you get a bubble, an asset bubble. So your assets are rising rapidly, your balance sheet is swelling, and you use those assets as collateral to increase your liabilities or increase your borrowing. This, for the normal person, this is akin to, say, the price of your house goes up 20%, and you take out a home equity loan. Same thing. Your assets just went up, your liabilities went up, but you still have equity. But the problem you have is there's sort of a Minsky moment, if you will, where the asset bubble bursts. And this is akin to what happened in 2000. It happened in Japan in 1989. It happened to the US in 2008. Then your assets go down, but your liabilities don't go down. You don't get to write off your debt because the value of your house went down.
Right.
And your equity is negative. So now you're in this situation where you have negative equity, and any income you get, you're using to repair your balance sheet. You need to pay down your liabilities. So the Fed's lowering interest rates, trying to incentivize you to borrow more money to stimulate growth. And you're saying more debt is the last thing I need. Every dollar I get, I need to use to pay down debt. And that in itself is deflationary, because going back to the velocity of money, if I have money and I'm basically paying down debt, and that money is then staying on a bank's balance sheet because nobody else wants it,
right?
Then you see how no money is being created and there's no inflation. No
one's buying sandwiches.
Right. Exactly. And the psychological impact of that is very difficult, because that goes to the paradox of thrift, where one person saving money, if this is your personal balance sheet, you say, this is in my best interest. I need to pay down my debt to rebuild my equity on my balance sheet. But if everybody in the economy does that, it's catastrophic. Mm-hmm. And that's what happens with these balance sheet recessions. It's widespread. This might, if there are people out there who owned a home during 2008, your balance sheet might have started to look like this. And you can think about the psychological reaction you had. Right. So this is something that's been used to explain what's been going on in the US post 2008.
Yeah, we think about not just your house, but you also think about your investment portfolio or your 401k. When those assets fall, your liabilities are not falling. So you're putting yourself in a position where you have negative equity, and that is a very uncomfortable position, not just personally, but like you don't have the ability to go out and get any new credit if you need it. Yeah. So you've got to have that time to repair. And I think that is one of the reasons why we've seen the flood of liquidity, because what happens is now the government has to step in and fill that gap.
Exactly.
And so they're filling it in by essentially keeping asset prices high, so people's balance sheets stay healthy.
Yeah. And that, I mean, I don't know if we can go forward a couple slides, we can speak to that exactly.
Yeah.
2 slides forward.
Take us 2 slides forward. Yeah.
Yeah. So post 2008, the private sector, what they're doing is trying to repair their balance sheets. So they're net saving. So that's what you see, the blue line post 2008. You see the net savings of the private sector is going up. And so if the private sector is saving, once again, going back to the paradox of thrift, what's good for one person, if everybody does it, it's bad. What has to happen if you want to maintain growth is the government has to be borrowing. They have to run a deficit at least equal to the private sector's surplus.
Right.
Because if the government is saving and the private sector is saving, then velocity of money drops to zero and GDP never recovers. So that's very important to understand. And then, really private sector has been trying to repair their balance sheets since 2008. And increasingly, the government has had to run larger and larger deficits just to try to offset that force and keep GDP growth where it's at.
Yeah, it's incredible. The pace at which these things have diverged is incredible.
Mm-hmm. Exactly. And another thing, many folks recall in our lifetime that there was one time where the government was running a surplus. And the budget was balanced, in the late 90s. You can see the red line goes above zero. And you think, well, if the government was net saving, how was the economy in a good situation back then? Well, because we know that the private sector, their balance sheets were expanding and they were dissaving. They were saving far less. So the private sector was able to offset the government's frugality, if you will, and keep the economy expanding. And the same thing happened again leading up to 2008. We know private sector balance sheets were expanding rapidly. People were sucking the equity out of their homes. assets were going up, their liabilities were going up commensurately. So the blue line's going down heading into '08. It allows the government to save more.
Mhm.
But increasingly, as we go through this crisis, asset prices have fallen. We know it's in everybody's best interest to keep asset prices as high as possible, particularly the Feds, because they know what happens to balance sheets right now if they fall. And so increasingly, the government has been called on to run larger and larger deficits.
Right.
And so how is that going to end up?
Yeah, and at this pace, at this stage, we're just beginning. The government's going to have to really continue expanding their balance sheet in order to get the private sector back on track.
And you can also, if you think about it in this framework, whereas if the private sector is saving, then the government has to be borrowing. What basically you come down to is, if you want growth, who is best positioned to expand their balance sheet?
Mm-hmm.
Who does that the safest? If the private sector expands their balance sheet too much and they take on too much debt and asset prices go down, well, that's a big problem, because the private sector can default. But the government, if they expand their balance sheet, they have a printing press. They can issue debt at the lowest rates in history. So it would seem, you follow this framework and you think, if I'm trying to generate stable economic growth, what I should have is stable savings from the private sector to make sure no defaults happen. And the government should just run larger and larger fiscal deficits to generate the growth that's necessary. Mm-hmm. And that is the economic thinking that's actually gaining traction right now.
Right. Which is, I guess, the green shoots of MMT and universal basic income, right? I mean, that's sort of the way the puck is headed here in this game. So we'll talk a little bit more about that, but let's jump back a slide first and look at the sort of the impact of the return on debt, because this is an important way to look at this globally, and how every dollar of new debt, how much GDP does it really lead to?
Mm-hmm. Yeah, this goes back to showing that a lot of academic research has been done that shows, as you take on more and more debt, increasingly the debt is being used for unproductive reasons or in unproductive ways. And if you think about that, that makes sense. I mean, if it's very hard to get a loan, then usually there are plenty of attractive investment opportunities out there. And if you are able to get a loan, you can invest in them and make money. And so there are productive uses of debt. But as the amount of debt grows, you have more and more money chasing fewer and fewer productive uses. And so each dollar becomes increasingly unproductive. So that's a long way of saying, if your debt gets too high, your growth is going to be impaired. It's very difficult to find a productive way to use that debt. And Carmen Reinhart and Kenneth Rogoff, they suggest that historically, once debt to GDP rises above 90%, the long-term growth potential of any economy is permanently impaired. And it doesn't happen in a linear fashion. So as debt to GDP increases, the growth potential decreases at an exponential rate. So more and more debt leads to slower and slower growth increasingly. And that goes to the marginal revenue product of debt. So you measure, for every dollar of debt in the US, how much growth is actually created. And this research comes from a number of sources, but Lacey Hunt does a lot of research there from Hoisington, and he's a great thought leader in the space. But basically, he suggests in the US in 2008, every dollar of debt was giving you 44 cents of growth. But by 2018, it was only 40 cents of growth. And that's not that bad.
No.
You compare that to the rest of the world.
Right, yeah.
Yeah. So
look at China.
Look at China, for example. 71 cents. Every dollar of debt in 2007, 2008 was giving them 71 cents of growth. Now it's 36 cents because of how much their credit bubble has expanded. And the other important thing to see is, none of these are above 1. Right. There is no productive uses of debt, because if you think about the debt to GDP in the US at anywhere from 110 to 130% based on the rapid debt increase that we're seeing now, globally, total debt to GDP, you're talking over 300%. So every additional dollar, it's just being used for unproductive things. Most of the time, it's being used to refinance old debt.
Yeah. You're just digging the hole deeper, right?
Yeah.
Yeah. So maybe just for a second, you made reference to the Minsky moment. Maybe just explain that for viewers so they understand what a Minsky moment is and who Minsky is.
Yeah. Hyman Minsky, he sort of became famous somewhere around 2008 because that's when the U.S. sort of experienced its first Minsky moment. And he basically laid out how you go from hedge finance all the way up to speculative to Ponzi finance. And this level of different levels of finance and financing, they happen during an asset bubble, to the point where at the very end of an asset bubble, basically you're borrowing money and you only are generating enough income to barely pay the interest on that debt, because your expectation is that the price of the asset that you're borrowing against is going to keep going up forever. So you just think about 2008, the housing crisis. I mean, you buy one house, it goes up 20% in a year. So you buy another house and it goes up 20% in the year. And you think, oh, I'm making a lot of money here. Towards the end, you're thinking, well, why wouldn't I own 50 houses? And if I'm going to take on debt to buy these houses, I don't want to put any equity down at all.
Right.
And you realize all of this is hinging upon asset prices going up. If they go down at all, you get that inverted balance sheet that we talked about with the balance sheet recession, and in a big way. And so all of a sudden there's a Minsky moment. It's that point in time where all of a sudden the asset prices fall because everybody realizes they're not generating the incomes to service the debt on them. And the asset prices start to fall and it feeds on itself in a downward spiral. So that moment, that theory, it just really gained traction post 2008.
Yeah. You'll hear that often referenced in times of exuberance.
Yes.
When things get a little crazy, kind of like they are now. Maybe just expand a little bit on, so you keep pushing on the string and you don't have people wanting to take on more debt, so the government has to continue their process of filling the reserves up, but nobody's borrowing, so we're in this deflationary spiral. And then at some point you have to look to the fiscal side, and that is where we're at, where we've started. And once the fiscal stimulus starts, just based on what we've learned from the PPP program, maybe just highlight sort of the research we did there and how people are looking at their incomes, just recently through the end of the summer.
Oh, yeah. Yeah, some of the viewers may have noticed the April personal income number was up 10% month over month. And you think, how is that possible? We have record high unemployment, but you're telling me that the income month over month increased by the largest margin in observable history. So people are actually richer now that the unemployment rate is at a record high. That doesn't seem to make much sense. And the reason is we've had the largest fiscal stimulus, far larger than what we had in 2008. And those economic impact payments, those stimulus checks, plus the pandemic relief, the expanded unemployment insurance claims, all those hit your personal income numbers, your personal income in the April-May time period, and inflated your personal income. But what is also important to know is our calculation suggests if you lost your job in March, and on average, the economic impact payments plus the expanded uninsurance benefits, what that means is you're basically going to have the same income you had in March or better through mid-August. So no loss in income whatsoever, even though you lost your job. And that does not include if you're able to put your mortgage in forbearance, which you can do for a year, or your student loans. So you look at any traditional macroeconomic model in the US, they're heavily based on the unemployment rate. The unemployment rate rises and you say incomes drop, consumption drops, bad news. Well, the fiscal stimulus, building that bridge, filling that gap, at least through mid-August, means that, there are a lot of people in the country right now who are in a better cash flow situation than they were when they had a job.
Yeah, sounds crazy, right? And that doesn't include if they received any severance payment from when they lost their job. So they could be in a very good cash position. And I think the stats we saw that somewhere in the neighborhood of 10% of all mortgages are in forbearance right now. So it's a large number of people taking advantage of that opportunity. So let's move on, talk a little bit about sort of how the deficits that we're running sort of evolve and when do they actually matter. So maybe Audra, if you can skip down a few slides. I'm not sure what number it is. Past this one. Yeah. So Mike, take us through this one.
So you're going back to the point where the Fed is pushing on a string. You've had a balance sheet recession. The private sector is net saving. And all the Fed can do is incentivize people to take on more debt, and they don't want them. They don't want it. They don't want to pay down debt. So the government needs to borrow more and more to sustain growth. They need to run a bigger and bigger deficit. Well, when does that matter? How big of a deficit can you run? And that's a very nuanced topic. It depends on a lot of things. It depends on who owns your debt. That's a big factor. So if the government is issuing a bunch of debt, but it's being owned by price sensitive buyers, what we mean by that is it's being owned by the private sector. That's a problem. So if the U.S. Treasury is issuing new bonds and the private sector has to buy them, well, then the private sector doesn't have any money to go spend on things to increase growth. So that becomes a big issue. And Peter Bernholz.
That's like the Japan, right? Japan had that issue.
That's exactly right. Yeah, they kept increasing their fiscal deficit more and more and more. And what was happening is the Japanese population was just buying the bonds.
Right.
And so you got no growth because everybody was just buying treasury bonds, Japanese government bonds, as opposed to spending money. So that's very important. Obviously, fiscal deficits matter if you're borrowing in a currency that you can't print. Think about emerging markets. They get into this trouble basically every 10 years where they borrow in US dollars, but their revenues are in Thai bahts or whatever currency you want to use. And so that's a big mismatch. And so they can default. But you think for the country like the US, where we can print all the dollars we ever need to pay off our debt, we're never going to default because we can always pay off the debt. What you're more worried about is when do other countries look at the US's fiscal deficit and say, I don't believe the US dollar has the value it used to have. The US has totally devalued it. It's funny money at this point. And Peter Bernholz in his research, he basically discovered going through past histories, once you get to, and this is a bit complicated, but once you get to the point where you take all your government expenditures, say there are $100 in government expenditures, when 40% or more of those are financed through deficit spending, meaning there are no tax revenues supporting them, and that deficit spending is financed by the central bank.
Right.
So debt monetization. That's when it gets to be total funny money and everybody loses confidence in the currency. And what you see is people not buying the debt, not using dollars, and then you get a hyperinflation scenario. And then you actually, even if you can print the currency that you're borrowing in, you can technically default because hyperinflation spiral gets so fast and tax revenues are received on a lag that you are not able to issue debt fast enough to prevent a technical default. And that's called the Tansey effect. So that's the end game. Where are we relative to that? And that's where you look at the chart. That's our current deficit as a percentage of government expenditures. I mean, you're at 40%. The good thing is the central bank is not directly monetizing the debt.
Right.
And, we've been above 40% right. We've been above 40% previously, and it didn't result in inflation. Japan's been near this point multiple times, and it didn't result in inflation either.
Right. And that's sort of the where you get a little fearful that something like MMT or universal basic income could skyrocket that number. And that would be more like monetizing your debt directly.
Yeah.
So maybe just to explain that concept, maybe Odd, if you just jump back a slide for the viewers, just to sort of look at sort of the difference between quantitative easing and MMT, sort of take us through this. This is a really good illustration here.
Yeah, we talk about MMT, which you think the central bank is basically monetizing the fiscal deficit. And you think about all the debt that's being issued now and how much the Fed is buying, and you're saying, how is what they're doing now not MMT? This is a distinction without a difference. And there is a pretty distinct difference between the two. And you can see as you walk through this why one is hyperinflationary potentially and the other is not. And so you lay out QE, how QE works. The Department of the Treasury issues a treasury bond at auction. The primary dealer banks, so think Citigroup, JP Morgan, Bank of America, those banks, they have to participate at the auction per the Federal Reserve Act, per the Federal Reserve Charter.
Right.
So they buy the treasury bond at auction. So the bank gets the treasury bond, they send the treasury money. Great. Then the Fed through QE says, all right, you give me the treasury bond, I'll give you bank reserves. So that's how you're sort of rinsing these treasuries and bank reserves. And what you end up with is the treasury got their money, the banks have reserves, and the Fed has more bank reserves and treasury bonds. So the key factor here, why this is not MMT, is bank reserves are not money. That's the big thing. The Fed can give the bank reserves, but only banks can make money.
Right.
That's the big difference. And the banks are the intermediary. And also the reason why they're such a great intermediary is they have finite balance sheets. So what you run into, you can see how this system breaks down. If the Treasury is issuing a ton of debt, ton of new debt, and the Fed's not buying, then what happens is the banks just get stuffed with Treasury bonds.
Mm-hmm.
And they have finite balance sheets. So more and more of their balance sheet is taken up by Treasury bonds because the banks are basically financing the fiscal deficit. And if the balance sheet is overtaken by Treasury bonds, what that means is they just have less money to do other things, to lend out to the economy. And so growth falls, asset prices fall until the Fed has to step back in. The Fed needs to be the backstop to allow the banks to get these treasury bonds off their balance sheet so they can go and extend loans to the economy and make money.
Right.
And so that's why it doesn't result in hyperinflation. And then in MMT, what you get is you say, okay, bank reserves are money. So you go to the Federal Reserve Act, you have an act of Congress that allows the Federal Reserve, it makes Federal Reserves legal tender. Mm-hmm. And then you cut the banks out completely. So now you have the Fed, who has an infinite balance sheet, can send an infinite amount of money to the Treasury and take all the Treasury bonds.
Right. Yeah, that's sort of when the game's over, right? That's the banana republic, right? That's
exactly. That's where it turns into funny money.
Yeah.
And you're relying on discipline from both of these parties to make sure this doesn't become hyperinflationary. Mm-hmm. And that's a leap. I mean, right. Yeah.
And perhaps one of the tangents from this is to discuss why is it different for the U.S. versus any other country? Maybe just give a highlight, like our banking system laws and our Federal Reserve laws are different than other countries. So maybe compare and contrast those to like Europe and Japan, et cetera.
Well, so there are other countries where the Fed can directly monetize the deficit, or the central bank can directly monetize the deficit. And what you tend to see, so that's sort of a lack of central bank independence, mm-hmm. if you will. And what you tend to see, particularly in election years, the government increases fiscal spending to try to juice up the economy, and it results in inflation. And then it can result in hyperinflation. And then the value of your currency erodes and you have big problems. So ours is unique in that sense that the banks are the intermediaries there.
Mm-hmm. Okay. And then the other complicating factor here is with the dollar being the world reserve currency, it has different implications on all of this stuff. So right. Maybe we can get into that later, but just give us a preview of why that matters.
Well, if you think over 80% of global trade is denominated in dollars. People use the dollar as their store of wealth globally. And if the people that create dollars are devaluing them rapidly, well, that doesn't just have implications for the U.S. It has implications globally. Mm-hmm. If Thailand is doing this, and the Thai bot has no value, a lot of people don't care because they don't own a lot of Thai bots, but they own a ton of dollars, mm-hmm. and so that would be a huge problem. And what you see is, this happens slowly and then all of a sudden, but what you'll start to see is other countries, instead of storing their wealth in just dollars, they start storing it in other things. They start diversifying into other currencies. They start diversifying into real assets. Because China, for example, they don't view the price of a dollar like, it's just a dollar. They view it, how many barrels of oil can I get with one of these? Mm-hmm. Right? Yeah. And so if you devalue them, then China thinks, well, now I can get less oil. This is useless for me. I shouldn't hold dollars. I should hold my money in something that can get me more oil, right. Raw materials, iron ore.
Yeah, hard assets, right? Yeah. Mm-hmm. Which then makes it a little more difficult to sort of use those assets if you don't have that ability to convert it into a currency that you can buy stuff with.
Yeah.
So maybe let's look at the last slide, Odd. Sort of we're going to do a lot more in this series, but the general idea of how do we get out of this, or how do we survive this? You said before, like one of the biggest ways to do this is massive austerity. I mean, that is clearly probably the best way. It's when you overindulge a lot, you need to take time to pull back and get your balance sheet in order and cure your spending habits and all that stuff. So,
yeah,
talk us through these.
Yeah, it's not a long list, right? How you get out of it. But there are plenty of historical analogs. Like we've gotten into a situation where the government runs these types of deficits and takes on this amount of debt before. You've seen it multiple times. In the 1820s, the U.S. government had a tremendous amount of debt, and you could say we got lucky. We discovered gold in the West, and that financed the entire westward expansion, and we basically grew our way out of it. So, all of a sudden, there are very productive uses of debt. I'm going to use it to finance an expansion to the West, and I'm going to find gold in the ground.
Right. So there's a productive use of debt. You got to return for that.
Exactly. Yeah. So, a modern day analog would be like if we were to discover cold fusion or something, a new alternative energy source or technology that was very valuable, right. That generated enough income that we could pay down all this debt without any inflation. Right. So you're hoping for one of those. Then in the 1870s, also ran up a lot of debt after the westward expansion, and it was a long period of austerity. And that sort of carried through until the roaring 20s, where we did it again. And then from the 1930s to the 1950s, had to get out of it again. And, a lot of folks attribute it to World War II is how we got out of it, because we got in the war late and we sold everything to everybody and made a lot of money. That helped. But the other part of it was mandatory rationing and austerity. A lot of people, and then the psychological effect of that was huge. A lot of people who lived through this time period never took on debt again. Right. They were afraid to use it. And it was a very deflationary time period. But the mandatory rationing, the savings of the private sector increased tremendously. And it was a really difficult period of time that I don't think anybody would sign up for again. And then you have Japan, 1990, after their asset bubble burst, their real estate bubble burst, and they're still trying to get out of it. They're still stuck in this pushing on a string where the private sector keeps saving, keeps trying to repair their balance sheets. There are long-lasting psychological effects of people who lived through this and saw their balance sheet go totally upside down and the value of their house drop 80%. And so they're still doing that. And the government is running larger and larger, taking on more and more debt to try to stimulate growth. The central bank is buying more and more assets, trying to help repair balance sheets. And it's just, you get a whole lot of nothing.
Yeah.
You get very little growth.
Yeah. And I guess as we sort of conclude this segment of the discussion, there is a lot of other factors that sort of present themselves now than they did in these other periods. And one of the most striking ones is the sort of the decrease in the population. So our countries are getting older. Japan, China, Europe, they're getting older. So you're sort of pushing up against this wall of you've got a lot of people who are aging, and it's going to be difficult for us to fight that along with this type of debt problem when you don't have a new generation coming behind you.
Yeah.
So we'll talk more about that stuff in the future. But this has been a great segment. We hope you all enjoyed the first phase of this, whatever we're going to call it. But we we really wanted to just present some of our views and just share with you some of the thoughts that we discuss a lot here and that shape our thinking. So, certainly if you have questions, let us know. You can always reach out to us. But in the meantime, thanks, Mike.